Today, we are going to be looking at a trading strategy that I've built for crypto that generated around 3,900% returns, so around 4,000% returns since 2017. Compounded returns, I have to mention. So every realized returns is compounded into the next trade, okay? Just realized. All of the data that you see here is generated from my own infrastructure. I build them and deploy them at Trading Research Hub. And I send at least one weekly strategy or review of an idea every week so that people can at least get ideas for themselves to test themselves on their own data, on their own platforms and everything like that. My idea is to build an archive filled with trading strategies that people can take and study for themselves. So today I decided to just give a brief overview of what we found from this strategy and yeah, go from there. So everything that I do in crypto, right? Because I am a crypto trader. Right now, most of my all of my trading allocation is to crypto and only a small portion is to equities. And equities is not trading, I just do investing. So I do a buy and hold of the general ETFs, and the risk exposure to trading, that's done of my crypto portfolio. So this strategy is a momentum strategy that I found. The strategy, if I'm not mistaken, was shared in 2020, between 2019 and 2020. It is a very basic momentum strategy. Like I said, I'll outline the rules, the broad rules, later in the video. But basically, you can see that the yellow line is the altcoin benchmark. So I grabbed the market cap for altcoins, for the altcoins market, from CoinGecko, and I measured the returns, the cumulative returns over time. I grabbed the Bitcoin, the BTC USD Bitcoin benchmark that I used as also the market cap of Bitcoin, and I've calculated the cumulative returns during this period from around 2017 and plotted them here. And then on top of that, I plotted our strategy here. Our strategy trades all available assets at Binance, and so it's not just fixed to Bitcoin or just altcoins or Bitcoins or to a specific group of coins. It trades everything that is available. And so as you'll see below, that gives a potentially better risk profile and also diversification. Even though Bitcoin has done better historically, as we know, it may not continue to do so in the future. Probably it will, but we never know, right? So we don't want to unless we want to make those bets on our own portfolios and we are conscious of the risks that we are too exposed to a single asset like Bitcoin. In trading, generally, I don't like to make those decisions. I like to let my models dictate what kind of exposures I get based on the strongest assets that are currently available, at least if I'm trading a momentum model. So if we compare the returns of the strategy by the different benchmarks, we can see that the strategy had around 3.9K compounded returns since 2017. The benchmark here is Bitcoin. I have to add here, just say Bitcoin. We can just write here. So BTC benchmark. And the altcoin benchmark performance around 1.6K. So the strategy beats these two by a decent margin. What is this strategy? Basically, at least the initial idea is that first and foremost is a systematic trading strategy, okay? Everything is defined. A lot of traders struggle with the psychological aspects of trading and holding through drawdowns and stuff like that. But the strategy that I'm going to present today, even though it was most of the time, or I would say all the time, exposed to the market because it's either long or short, and it has a bunch of assets. At the latest time, we had like 400 assets available at Binance to trade. So even if the market was going through deep bear markets, right? Into 2018, in 2022, stuff like that, you are still exposed to the short side. Even though you are not making much money, because the majority of money obviously is making during bull markets, the short side still added a nice robust way to decrease the drawdowns and the volatility during those bad periods, let's say. So, like I said, the strategy experienced way lower volatility than what was the market. So the market was around 81% volatility, and the strategy experienced around 38%, which is a very high reduction, and it's just basically on the way we construct it, right? It's if you give proper risk management to strategies and you keep your portfolio allocation in check, you can reduce volatility by a decent margin than just a buy and hold of a strategy, of an asset. So how do you consistently capture profits while protecting our capital against devastating drawdowns? This is a good question because most traders don't know how to do that. You can never avoid drawdowns like we talked about before. Drawdowns are inevitable. The market will go in and out of sync with your own style of trading, right? So you can never truly avoid drawdowns, but you can be smarter in the way that you approach them and try to reduce them by being a little bit more conscious about risks. And for example, if you are going to do volatility targeting, that is something that we'll talk about below in this section. You can start to adjust the portfolio to the volatility that you want and not the volatility that the market gives you. And I'll explain. It might seem complicated, but really is not, and I'll show you how. So this systematic approach, this trading strategy, has delivered 3.9k returns, compounded returns, while maintaining a maximum drawdown of just 27% over the entire period, which is quite good. And especially good when we compare it to the 93% drawdown that we get during the same period, okay? One of the most important factors of any trading strategy, okay, and this is something that I talk a lot about, it's to always have an economic rationale for why you should be getting paid for your exposure or for your risk in the market, okay? What is an economic rationale? So, for example, many traders look at a market like this. They see price trending up, they see here lines, whatever, they say this line is a resistance, this line is support, whatever discretionary traders call them these days. I see them nowadays calling them liquidity gaps or whatever they are talking about. And when you think about it, you are paid in the market for doing services or to do something or to carry out some risk. That's the nature of any financial dealing in markets. And financial markets are no different than that. Like, for example, a bank, it lends you money and you have to pay interest on that loan, right? Because the bank will carry the risk that you default on that loan, and they want to get paid for that risk. An insurance company on your house will get monthly premiums, and you pay for that monthly premium. So in the eventuality that something extreme happens, they are there to cover it, and they want to get paid for that risk as well. So in financial markets, that is always the same. You need to know what kind of exposure you are getting and why you are getting paid for it. Why should the market pay you to take that position? And no, like trading at a resistance line or at a support line, that's not a sound economic rationale to get paid for, okay? In the future, I might make a video around economic rationale and how to think about that, but for today, let's keep it that way. So one of the economic rationale behind this strategy is that we have a phenomenon that is around trend persistence in financial markets. Okay, there's many reasons for this. Some people call it that it is because hedgers in future markets need someone to sell them, to give them exposure to whatever they want to risk they want to hedge. Other people say that other studies say that it is behavioral. People that see stocks going up, they want to buy more and makes the stock going even higher, or the asset going even higher. So there's a bunch of different ideas. But one idea is that there's this behavioral factor that dominates. And you see that from research from going back to the 80s. And yeah, it's a phenomenon that is quite well studied, and that is that price movements exhibit some positive serial correlation. Now, this might seem a big word, but it's really not. It's just that you say that future price has correlation to past price. So meaning that things that want to go up, that go up, have a tendency to continue to go up, and things that go down have a tendency to continue to go down. And you can make the argument, like I just said, to be a behavioral pattern, because, for example, people that they see Bitcoin going up, right? They see it going up and going on the news and go everywhere, and people naturally get FOMO, right? They want to be part of it. They want to make money like apparently everybody's making, and so they go into the market and they buy. And when prices start to go down, they get scared and they sell their positions, and all the world imagine that impact like at scale, right? It really drives market impact, and that is one of the theories around momentum and trends, and that's why it continues to work, or the effect continues to be present in markets. And cryptocurrency markets have no fundamentals, so this stronger trend persistence seems to be even stronger in crypto, because there's not many like fundamentals driving price action. You don't have like PE ratios, you don't have revenues. In most parts, some protocols have, but whatever. So everything is mostly dominated by momentum and by this like highly speculative action. And so a positive serial correlation, usually it's called positive autocorrelation, occurs when past returns influence future returns in the same direction. So it's just just like I said, if something is going up, we make the assumption that it will continue to go up. How strong it continues to go up, that is already dependent on the model and on the signal that you use. In this case, the signal that we will be using will be an EMMA, but for this model, it was a derivative or a rate of change of that EMMA. So instead of looking at traditional like close above the EMA, right? That is usually a strategy. In this strategy, the model looks at an EMA rate of change. Okay, sorry with my bad writing. And this is just a way to measure trend acceleration and deceleration. And as we've seen, this seems to be fairly robust when you look at the results of such strategy on a wide number of crypto assets, right? And for position sizing, we use the target volatility of 40%. And yeah, we used it at the start of our positioning. And what is target volatility? Okay. Volatility targeting ensures that the assets get smaller positions when they have high volatility, and get lower volatility assets get larger positions. Now, let's take this assumption. Let's say that you are trading SPY, right? You are trading SPY, and you also want to be trading BTC. Let's keep it simple. You want to be trading BTC. One might have, let's say, 10% annualized volatility, and the other might have 60, maybe, okay? And you want an equal portfolio trading each of them. So you don't want SPY to contribute too much to the volatility of your portfolio, so you don't want it to make your portfolio too slow, let's say that, And you don't want also BTC to contribute disproportionately to your portfolio, right? For example, if you put $1,000 in SPY, and if you put another $1,000 into BTC, right? Maybe BTC contributes disproportionately to your portfolio's volatility, and SPY, let me put another color here, and SPY might contribute very short volatility, very contracted volatility, right? So you might get a lot of returns when BTC is really strong, but you might get really deep drawdowns when Bitcoin naturally goes through the 80% drawdowns, right? Because Bitcoin has regular every 2 years or something historically has had like 80% drawdowns, and SPY not so much. So if you want these two to contribute equally to your portfolio, you can all of this implementation, by the way, is on the newsletter that I just said on Trading Research Hub. So I'm way more specific than I'm being here for the purpose to keep this short. And one of the things that, and as I was saying, to keep the volatility estimation, let's say the volatility of each asset equal so that they contribute the same to the portfolio, you measure the volatility over the past, I don't know how many days, how many months, whatever, and you forecast that volatility into the future, and you size your position according to that volatility. So let's say that since BTC contributes 60%, you allocate, I'm making up random numbers here. You allocate maybe 20% of your portfolio to BTC or 30 or whatever, and the remaining 80% or 70% you allocate to SPY. So basically you neutralize the volatility of each of the assets, and they now contribute equally to the same volatility of the portfolio. Okay? And now they are the same basically in your portfolio. Of course, you are making different bets here, but the reason for the allocation is not valid here. I'm just saying, things being equal and you wanting to have both in your portfolio, you have to look at the volatility of each asset. Okay, and you can see that even at the strategy level, if we look at the volatility of each strategy, for example, the strategy has 38% volatility. The market in this case is BTC. It has 82% volatility, and the altcoin benchmark has 82% volatility, and BTC has had a 70% annualized volatility over its price history. So much larger, much larger than the strategy itself. And why is 38% volatility of the strategy? Because we targeted it at 40%, right? Of course, it won't always be perfectly matching the 40% or whatever target volatility you choose, but it should be around that, okay? Because we use this tactic here of allocation. And yeah, I posted here a chart of the number of signals per day. You see that over time it has growing. It grew a lot, and it is capped at 20 because I use the maximum allocation at any day. Like any day that you look at your portfolio, it only must have 20 positions open for this test that I used. Okay, for this strategy, only 20 positions are allowed at any given time to be opened. So the number of signals, you see that they grow year after year, and then they stagnate at the 20 because that's the maximum that I allow. They grow because in 2018, Binance only had a few assets listed, right? It had BTC, ETH, later on it had XRP, then BNB, and so on. So the universe scaled as time went on. And that's why you need to cap it, because at one time you can have like 100 signals and you don't have cash to allocate to 100 positions, right? So you need on the back test and on the simulation, you need to make sure that you have a cap for it. The number of open and long positions, I find this one interesting because you can see that like in periods of high stress, you can see that the short positions dominate. Like in 2022, it's mostly driven by short positions. Everything is very red, so the portfolio is net short usually. And during high periods of a lot of strength, the portfolio, let me put in green, the portfolio here is allocated mostly to long positions, and that's how it should be. At the end of the day, this strategy produced the strategy demonstrated rules against both comparative exceeding the benchmark by, we exceeded the benchmark by 1.3k and the total market cap by 2000%, which is a lot, especially considering that we reduced volatility by a lot. And the strategy annualized return is 56%, while the benchmark and the total market is around 70%. So the strategy naturally had a lower annualized return because we decreased the volatility of the strategy. The annualized return is just a metric to annualize the returns that you get, but it doesn't indicate the full return, but it's natural that it is smaller because we don't allow so much volatility. When the market is really volatile, like you see, for example, during 2021 and everything, even though the volatility is extreme here, we maintain it rather like stable because of that, of what we discussed here. Then you can see some more statistics. You can see that the Sharpe is around 1.5, which is a lot compared to the benchmark, which is around 0.8. You have the maximum drawdown that you just saw, much lower. The average drawdown is also much lower than the benchmarks. The maximum drawdown duration is also much lower, which means that it takes a lot less time to recover from drawdowns in this strategy. The average drawdown is below 50 days, when for the benchmarks is above 50 and getting close to 100 days. You can see I like these metrics because they tell me more about risk-adjusted returns, equal to what the Sharpe ratio tells me. And I'll tell you what the Sharpe ratio, if you don't know, is very briefly. And basically what these metrics tell me is that how much return do I have to the maximum drawdown. So what is the ratio from the total return that we have acquired to the maximum drawdown that we have on the portfolio? And for example, the total return is about 100 times more. It's like 150 times or so higher than the maximum drawdown, and that's very good. For example, our return here is 100 times the annualized volatility ratio that we have. So, and you can compare it to the benchmarks and our risk-adjusted returns. So all the juice that you get for each unit of risk that you put in the market is much higher. And these are the type of strategies that we want to find. A quick explanation of the Sharpe ratio. A Sharpe ratio is a metric in finance that is used to evaluate the risk-adjusted return of an investment, or in this case, a trading strategy. It will tell us whether the returns are worth the level of risk that we are taking. So the higher the Sharpe that we get, the better. And usually a Sharpe of 1 or above is really good, but it's not a necessity, okay? You can trade a 0.5 strategy and still make money, especially on traditional markets like stocks, bonds, commodities. You won't find strategies with a lot of Sharpe because those are more efficient markets, and the efficiencies are more, let's say, more pronounced because they are more discovered and they are known for many years, and many traders and funds exploit them, so they are smaller. But in crypto, you still can find some strategies that are above Sharpe 1, like we see here. And that's why I'm in this market as well, right? And you can see that the strategy Sharpe for this strategy is 1.5. The market, if you are just holding long, is 0.89, and for BTC is 0.98. So our strategy beats both in returns and also in risk-adjusted returns. And risk-adjusted returns is what we are really after, okay? Because anyone can beat the S&P 500 if you leverage, for example, you want to beat the S&P 500 tomorrow, right? The S&P 500. You want to beat it tomorrow, right? You just leverage it 2 times. okay? And you beat it. The absolute returns, you beat the S&P 500. But that's not really something that we should do, right? That's not really something smart, right? Because you are not having, you have the same risk-adjusted return. You don't have the same risk-adjusted return. You have now lower risk-adjusted return. You just increased your leverage by 2 times. That's not really the point. You want to have something that you have similar risk or lower risk but higher returns, and that's why we look at risk-adjusted returns, because for the same unit of risk, I'm getting more juice for each dollar that I put at risk in the market, and then you can really maximize the potential of that strategy there, because you are getting much more for each unit that you put into the market at risk. And that's where the secret sauce is, right? It's on getting higher Sharpe strategies, higher risk-adjusted strategy on a bunch of different metrics, and really squeezing them out of the market. And those are really hard to come by. That's why this strategy is so cool. You can see that I put here an interesting chart of the annual Sharpe ratio. So for each year, you can see that some years the strategy Sharpe ratio is smaller. On other years, like 2018, that was a really hard year for crypto, it is more than positive. You can see that in 2021, it beat the market, both BTC and altcoins. In 2022, a really hard year, it still beat the market. You still got 0.52 Sharpe, while the market delivered very negative Sharpe that year. And it continues. It never had a negative year in terms of Sharpe. So that's why it's a very interesting strategy. We had a maximum drawdown of 27%, like we said above, compared to the market of 83 and 92%. The average drawdown is only 12%. And the maximum drawdown duration was 426 days. And for the other benchmarks is around 1,000 days, so more than double. And you can see here a bit more. We can see also the returns. I'll make this chart a little bit better. The returns are non-compounded returns and annualized, so these don't match the compounded returns. I'll make how can I say a better label for next time, but for now you can see that most of the month we are positive. Positive is this not yellow, orange line. Next time I'll make it all green. Everything that is positive is green. Apologies for that now, but I just want to share this strategy. And you can see that most of the months we are positive. And yeah, that's it. You get, even in 2022, for example, you had January which was positive. You have a few months that are negative, but didn't even like take from the positive. Then you have two big months, one big red month, and then followed by small red month in a positive month. Then you have a large month in 2023. I remember this time perfectly. I made a lot of money personally here too. And then you have a very bad month in March 2023, which was very hard, and also April. But then at the end of the year, you recover everything and much more. So very consistent strategy, very robust. How is the signal? Before we go to the signal, I just want to say that I have a newsletter. These tests take me literally dozens of hours to test. Not even talking about the hundreds of hours I've put behind, like building the infrastructure so that all of this data can be correct, because there's a bunch of backtests online that don't show you. They don't even go to the part of portfolio management. When it comes to a bunch of signals, like I said, I'm trading all the signals available at Binance and managing the allocations and accounting for fees and costs and everything like that. That's very complex on the back end. And I share every week, I try to share at least one trading strategy. We are right now on 59 trading strategies and ideas and concepts that I've shared. We share one every week. And sometimes I also talk about my own trading performance, and yeah, basically that. If you want an archive of trading strategies, subscribe for free, because I think I think most people take a lot of value from it. In terms of the signals for this strategy, like I said, is an EMA derivative trend reversal system. It takes an exponential moving average. The long position is when this derivative changes from positive to negative. So for example, the rate of change of the moving average is negative and suddenly turns positive. The strategy goes long, and once it goes positive and starts turning negative, the rate of change, the strategy goes short. Okay, and yeah, that's basically it. And the reverse is the exit signal. I hope you've enjoyed this review of trading strategies, and I'll come back with a few more next week.